Good evening, everyone, and a very warm welcome for today's webinar. On behalf of NISM and India Bonds, I would like to take this opportunity to welcome you all for today's webinar on bond investment made easy. Myself, Ami Sayed, working with NISM. Along with we have today a renowned speaker from the industry who will be taking today's webinar. We have Mr. Sunny Mirchandani, Director, India Bonds founding team, and Dr. Kapil Shimal, Associate Professor at NISM. Before we begin, let me allow to give a quick introduction of our speakers. Dr. Kapil Shimal is Associate Professor at NISM. He is having more than 13 years of experience into academics and one into corporate. He has started his career with ICICI Prudential LIC and worked with institutes like Prestige Institute of Management and Research, Indore, Symbiosis University of Applied Science, Indore, Marwadi University, Rajkot, etc. His last assignment was with PIMR, Indore. His main area of teaching and research is financial planning, portfolio management, derivatives, financial modeling, financial management. He has conducted many investment awareness programs on behalf of SEBI, NSE, and ICA India. Dr. Shimal has received Best Faculty Award by Dainik Bhaskar in the year 2012. He has also received Best PhD Thesis Award by Jaipuria Institute of Management, Indore in the year 2018. He is into editorial board and reviewer member of International Journal of Accounting and Financial Management Research. Dr. Shimas has done his PhD in management from Mohanlal Sukhadev University, Udaipur. He has also cleared NET exam RPSC set in management in year 2012. Now let me introduce our other speaker, Mr. Sunny Mirchandani. Sunny Mirchandani is a founding team member of India Bonds, who having 18 years, more than 18 years of experience in investment banking, debt capital markets, and real estate financing. He was earlier associated with Citigroup and Eki Capital as a part of their investment banking team. In his last stint, he headed the real estate underwriting book for NBFC arm of Eki Capital Finance and have been instrumental in concluding transactions of REITs in REITs and renewable energy space. Mr. Mirchandani's career highlights include pivotal roles at AK Group, where he managed high-quality asset-backed credit and structural transactions. Mr. Mirchandani holds a postgraduate degree in business management from NMIMS Mumbai and bachelor's in finance from Mumbai University, making him a well-rounded leader in financial technology and investment strategies. Before we begin, let me tell you what are the major areas which we are going to cover today. The basics are the major areas which we are going to focus for today's webinar will be basics of bonds. What are the benefits of investing in bonds? What are the risks associated with investing in bonds? What are the yield or return and factors affecting it? We will be taking all the questions at the end of the webinar. So requesting all the participants to put their queries in the Q&A board only. Our speakers will be happy to answer all your queries. So without taking any further time, I would like to hand over the webinar to our renowned speaker. Over to you, sir.
Thank you so much, Ahmed, for the introduction for Dr. Srimal and myself. Uh, Before we begin the webinar, I'd just like to, I hope I'm audible for everybody. Uh, Before we begin the webinar, I'll just quickly give you a brief in terms of what are the options, what exactly you will learn from this webinar. Just give me 1 second. I'm just sharing the screen. Okay, great. So, thank you so much to NISM for inviting me and Dr. Shrimal also for this. What's in it for you as an attendee? What will you be covering? Like Ahmed pointed out, very basic terminologies that is required for investing or understanding bond as an asset class. How you should read the credit rating of any bond. What are the various categories of credit ratings, which is a high risk, which is a low risk credit rating before making an investment in bond, or advising your investors before making an investment in bond. What is the return that you can expect from bonds across various rating criteria? So we'll show you some examples also. Uh, what Dr. Srimal also will be covering is the risk that you need to identify while making an investment or advising your investors while investing in a bond. Just something that NISM has helped us is that everybody who attends today's webinar will also be getting a certificate of participation from today's webinar. We'll try to cover a few questions as well in the Q&A section, which will give you a complete insight in terms of what are the points that we'll be covering. Everything from a basic to what are the difficulties that you can face, everything from this webinar. This webinar will be like a 35-minute session, and then we'll have a 15-20-minute Q&A live session as well. Some of you have posted queries also while registering. We'll be addressing those queries as well. I'll hand over the mic to you, Dr. Shrimal, for this webinar, and we'll take it forward from there.
Sure.
Thank
So
you.
thank you, Sunny and thank you, Amir, for the introduction. I think I'm audible. Yes.
Very much.
Yes. So the today's webinar is basically the idea about what bond market is and how it will be useful. So the first thing, what bonds are, the basic of the bonds that we all know. As we know, there are the various asset classes available into the market for an investment. But this particular webinar will be basically for the bond, and we'll discuss the bond is. So what bond is? So let's take a very simple example. So this is a financial instrument where one can invest into the market, especially when one can invest into the market with a fixed term. Okay, now we can say about for the fixed term, when the company is coming with a bond as an issue into the market. So the first thing is that the bond is having the fixed term into the part. Number two, it gives the regular income to you in the form of the coupon. Okay, the coupon rate, it is mentioned in the bond when it has been issued into the market. Okay, number two, that is a coupon that has been given to you. And number three, that we can say whenever the bond is issued to you, it is known as the relationship between the investor, that you will be called as a lender to the company, and the company will be the issuer, that will be the borrower. So it is nothing but the company is taking a loan from you. On that loan, company is going to provide the interest till the maturity to you. So that is a simple concept of the bond is there. Now, generally, when we say about the bond market, which is available in Indian market, so bond market will give the fixed rate of interest for the particular time. So that is known as a plain vanilla bond. When we'll go over the various types of bonds will be there. So that is a plain vanilla bond. I'm just giving the example of the plain vanilla bond, where bond is having the face value, certain coupon rate, and the maturity. So I'm just giving one example. When a company is issue a bond with a face value of 1 lakh rupees, one bond face value is, let's say, 1 lakh rupees, with a coupon rate of 7%, and the maturity is 10 years. So the company is going to give you 7% of 1 lakh rupees, that is nothing but 7,000 rupees per annum as a coupon or the interest to you till the maturity. And at the time of maturity, company will give 1 lakh rupees back to you. So when you hold a bond for till the maturity, company is going to give the fixed return to you. That is the plain vanilla bond example I am just discussing. Okay, so the bond is having a fixed term. That is the most important part, because there can be the irredeemable bond is there, but generally bond which are issued into the market or Indian market, that is into the nature, the fixed term should be there. And it is called the loan. Now we'll say about the loan. So how this loan will be useful to you, whenever the time of the liquidation, the company will give first right to the bond holder at the time of the liquidation. Okay, so whatever the value will be given, the first right will be given to the bond holder. So that is another important part. And you lend the money for the specific period, that is a part. Now we'll say about what are the various characteristics of the bond market. So first characteristic is the issuer or a company. So whenever company is coming with a bond to issue into the market, it is just like the process of the IPO that we can say. So the company has to build up a prospectus, the bond trustee will be, or the debenture trustee will be appointed. The company has to draft a prospectus to the SEBI, then SEBI will approve, and board of directors meeting, and so will be there. All the parts will be there. Okay, so company will give an overall picture about the bond to the market. So company must take an approval from the SEBI. Number one part is there if bond is going to list into the market. That is a part. Number two, generally the bond is having the face value of 1 lakh rupees. So each bond which is issued into the market as per the SEBI regulation, it should be the 1 lakh rupees is the face value of a bond. Number three, the bond should pay the interest rate. So here the example is given 10% per annum. Now interest can be paid either annually or half yearly or quarterly or monthly, that depending upon the nature of a bond. So when you go into the market, you will find that some bonds are paying the half yearly interest, Some bond that is a coupon basically. It's a half-yearly coupon. Some bonds are paying the annual coupon. Some bonds are paying the quarterly coupon. Some bonds are paying the monthly coupon. That depend upon the nature of the bond. So that is a quarterly payment or monthly payment will receive to you. The next characteristics that the fourth will be the bond must be rated by a certain credit rating agency, and that credit rating agency either will give AAA to the B triple B minus, or let's say AA plus or something rating will be there. That rating will give the idea about the credit worthiness of that particular bond into the market. So whether it is invested graded bond or not investment graded bond, I think Sunny will cover this part in the next slide. That is an important part with, because when the bond is issued into the market, as an investor we have to understand whether it is investment graded bond or not. That thing must be there. Number 5 will be the maturity or the redemption date or the repayment date will be there. So the maturity will be, let's take an example, bond is issued for the 10-year. Today is 27th of August and company is coming with a bond that mature after 10 years. So the maturity will be the 2034 August will be the maturity. And just simple example will there, it means that at the time of maturity, the company is going to pay you the principal amount or the face value amount that you invested back to you. That is a simple example of the plain vanilla bond. And finally, investors. So anyone can be the investors of a bond, like we can be the individual investor, can be the corporate investors, or can be the institutional investors. Okay, that depending upon the issuance of the part. But in a simple example, if we'll say what bond is, so bond is nothing but a financial instrument which a company issued into the market with certain face value, having certain coupon rate, and maturity date will be there. And at the time of maturity, company will pay coupon back to the investor, and till maturity, company will pay coupon to the bondholder. So this is an example of the simple plain vanilla bond into the market. These bonds first come as a primary market as a part of the NFO, then it will be listed in the secondary market on the platform of the NSE, BSE, other platforms are there, where one can trade into the secondary market, and it helps for the liquidity part for investors, or the individual will be there. So this is an example, this is an idea about the basics of what bond is. So now think, Sunny ji, over to you for the next part.
Thank you so much, Dr. Shrimal. Dr. Shrimal, like we had discussed, to make this webinar a little more interesting, and it
Yes.
shouldn't be one-sided conversation from myself or from Dr. Shrimal, what we have done is, for all our participants, we have added small polls, just a multi-choice question that will help us understand our audiences. We can present them better. I would request everybody to please participate in this poll. Everybody can see the poll right now on the screen. I'll read out the question. What describes you the best as an investor, or whether you're a student, you're a financing learner, you are a financial advisor, or any other? So this is just to understand the audiences better, so that Dr. Shrimalji and myself, we can go ahead and explain things more from that perspective. I'll again repeat the question. What describes you or your current role the best from the four options? Whether you're an individual investor, you're a student, you're a financial advisor, or others. We'll run this poll for another 30 seconds. I request everybody to please participate. We already have 80% people participating. We are waiting for the balance also to please participate. Everybody can see on the screen. Let's try and make this more interactive, more interesting, so that we'll come up with 2, 3 more questions. Before we present the next slide, we'll also, any future slides, we'll do ask some questions to understand the depth or the knowledge, so that we can try and help you educate, or help. The whole initiative is purely from education perspective. I think we'll end the poll. We have almost 90% participation that is coming. But I request everybody to please do answer, whoever is pending. Shrimalji, should we move on to the next slide?
Yes. I
Okay.
think we have an answer, then definitely.
Yes. So we understand that a lot of you are fairly, almost 40% of you are individual investors. There are over 30% students who are also there. Plus, there are a lot of financial advisors or distributors also, more than 25-30%. Just to give you some perspective, who are a part of this poll today. Just to add to what Dr. Shrimal said, the first thing that we need to understand is, whenever you're making an investment in an instrument, first thing you need to understand is whether that instrument is regulated. Every bond that is currently available as an investment asset class, first thing you should check whether it is a listed instrument or it is not. Any bond which is listed will be regulated by SEBI. Any bond which is not listed will not be regulated by SEBI. Hence, I would urge any investor, any advisor to do ensure and check that through whomever you work as an advice or make an investment, do ensure that the instruments that you invest are regulated. It helps you to protect your principal, protect your money, and also reach out to regulators who can help you solve your problems. So a lot of you guys are raising questions in the Q&A. Like Dr. Shripal said, these bonds are listed on the capital market as well as wholesale debt market segment. Face value for public issue is as low as 1,000 rupees. For private placement till now has been 1 lakh rupee. SEBI has made certain initiatives that the face value or the minimum investment value in the wholesale debt market or the privately placed but listed bonds will come down to as low as 10,000 rupees. The biggest problem that was there in the bond market was being big in size also. It wasn't accessible to our investors with a lot of initiative from SEBI, support from SEBI, education initiatives by Dr. Shrimal. Also, online platforms are educating our investors, our distributors, and increasing accessibility for these bonds. Now, these were the basic characteristics, but one of the basic angles that a lot of people want to understand is how do you understand equity? Though there are a lot of advisors who keep on explaining, but on the bond space, what is it? Bond is something like an FD, but listed and rated and tradable. How do you differentiate between a bond and an FD? It's a financial instrument which is listed, tradable, as well as rated, right? Not all bonds are rated, but I would urge that whenever you look at investing in a bond, you should look at credit rating as an option. So the risk reward ratio works this way. If you see on the screen, a AAA bond is something which is relatively less risky. Are financial instruments risky? Answer is yes. Every financial instrument, whether it's an insurance, whether it's equity, whether it is FD, whether it is mutual fund, whether it is fixed income, which is bonds, it does not change the fact that any investment, even if today you make an investment in real estate, that also has certain risk attached to it. But to assess, we have a SEBI registered agencies, which is like CRISIL, ICRA, India Rating, CARE, Acute. There are other rating agencies also which rate a bond. These are SEBI registered neutral third party rating agencies which give a third party opinion. Does this mean that it is 100% safe? Answer is no. There will be risks. Hence, it is very important to you to make investments, make any decisions based on informed decision making. And that is what we are enabling. That is the reason why today NISM has invited Dr. Shrimalji and me to ensure that our investors are educated or informed about before making any investment decisions. So the first thumb rule that we need to see is whether these are listed, these are regulated or not. Second, what is the credit rating of a bond? The higher the risk, the higher the return. Simple, a risk reward ratio. A AAA bond will be more less risky, I would say. Not that it is risk free, but it is less risky. A AA plus will be the next category, which will have relatively high risk. A AA, relatively higher. AA minus, if you see the graph goes from green to a red. Anything below triple B minus is a non-investment grade. It is called as a junk bond. So I would request that whenever you're making your investment journey or whenever you're advising your clients, the first thing that you need to see is what is the risk profile of the investor. I would never suggest you to take very high risk products without understanding the risk. And anything below triple B minus is a non-investment grade. In very crude word, it is also called as a junk bond. The higher the risk, the lesser the liquidity. Hence, the lower the risk, the higher the liquidity. Coming to the aspect, these bonds, whichever are listed on the capital market segment, most of them, or on the WDM segment, most of them are rated. Hence, whenever you're looking at making an investment or you're advising your clients, First thing you need to understand is the risk of the client, the tenure of the client that he wants to invest, and also the rating. This will derive or understand the risk reward ratio whenever you're making any such investments, right? Shimalji, would you like to add something to this?
No, no, sir. That
Okay.
is.
So, before we move on,
But there are
probably
certain questions, like if I can see, like whether this triple A rated or double A rated can be the risky, the default risk can be there or not.
absolutely. There is, like I said, there is no AAA rating. It's a third party neutral opinion. Depending on the assessment that Prodec, CRISIL, ICRA, India Rating, CARE, Acute does, they give a third party opinion. It's helping you or guiding you to see and go through the risk mechanism that is there, the risk attached to any investment. These rating reports are not very easily available. However, in case if anybody wants to see that, you can go onto these rating agency websites or a platform like ours, wherein this is freely available for your education perspective. Whenever you want to make an investment, I would also like to highlight, ensure that you go through two documents. The Bible of any bond is information memorandum, which has to be available with an online bond platform, which is a SEBI registered online bond platform. It can be any. Like ourselves, we are a SEBI registered online bond platform dealing only in listed bonds. So if you want to look at or go through an information memorandum which has the terms and conditions of a bond, just like an equity prospectus, which is available with SEBI or with the lead managers, after the issuance is done, it is available on any platform. It is compulsory for an OBP to show it for all our investors. Second, the rating release also is available on on any platform of an OBPP. I would request before making an investment, please go through it. Ask your advisor, ask your relationship manager, ask questions. Only then make a decision and make a more informed decision, right? So we'll definitely take up the queries that are there on this towards the Q&A session. We'll probably we'll run another poll, Srimalji.
Yes, yes, please.
Yes. So for all the audiences who have right now understood the credit rating, how it works, we've raised the next question. What is the primary objective for investing in bond? Whether it is income generation, it is capital preservation, or it is diversification. Just to understand the audiences better, again, this query is there. What is the primary objective? Whenever you are basically, why are you attending this webinar? Is it when you want to invest in a bond, if you are an investor, if you are an advisor, or why would you want to understand this asset class? So I would request everybody to please do participate in this poll. It just helps us understand this better, whether it is for income generation, capital preservation, or diversification. Depending on the risk reward ratio, you guys can choose that what bond you want to invest. If you want to do capital preservation, then I would advise or I would suggest that you could look at something like a government security, which is above a triple A rating also because it's sovereign, because it is issued by GSEC, is issued by Government of India. It is available through RBI Retail Direct also. It is available through any platform also. You can buy in demat form as well. So it's the lowest risk. They call it risk-free rate is GSEC. So it is above a triple A as well, which is got the lowest risk. Does not mean it's zero risk. It's the lowest risk. At the same point in time, it is also highest liquid, right? I think a lot of people have already, more than 90% have participated. We have the answer. So 40% of the people say that it is for income generation. It's like passive income generation. When you are sleeping, it helps you earn interest. Then there is capital preservation. So people who look at capital preservation look at higher rated bonds. And for diversification, because if you have any specific asset class exposure, either real estate or FD or direct equity or mutual funds on the equity space, then you want to diversify. That's when you invest in this, right? Okay. Uh, a lot of you guys have asked what is the risk reward ratio. So these are just some examples that we've created. This does not mean this is not an advisory. This is purely from education perspective that what is the tentative or expected return. It can be plus minus 0.5%. But whenever you invest in a central government bond, which is a GSEC, government of India has issued, you can expect a return of anywhere between 6.8 to a 7% kind of a return. In case if you have a little higher expectation in terms of yield, then you can go for a AAA bond, which will be the likes of REC, NABARD, LIC Housing Finance, HDFC. These are AAA rated bonds that you could look at investing. What is the return that you can expect? You can expect anything between a 7 to 8%. There are various platforms that you can go and check. You can check with your broker, they can help you. You can do a little bit of Google and you'll be able to figure out what are the options available, or you can go on any of the online bond platforms like ours. Then, if you want a little higher return, Credit Access Grameen, IIFL, which would give you a return of anywhere, or a Hinduja Land Finance, they will give you a return of anywhere between an 8 to a 10% kind of a return, which is like a AA rated paper, which can give you some higher returns. So, compared to an FD, a little higher return, but here you are increasing your risk reward. Then there are some bonds which are A rated, right? So obviously between A or a AA, there is AA plus also, and there is AA minus as well. But we are just try to make it more simple. Hence, we are giving the broad spectrums. A rated would be something like an ESAF Small Finance Bank or a Utkarsh or Spandana Spurti, where you can expect a return of anywhere between a 10 to an 11.5%. In case if your investors have an expectation which is higher than 12, 13, 14%, then you could look at a paper which is triple B plus rated or a triple B rated, which is like a Manba or a Satya Microfinance. Anything which is below a triple B minus rated is a non-investment grade. That means you can expect a return which is more than 14, 15%. However, these are higher risk products. You have to understand the risk reward ratio. Your financial advisor or your or somebody who advises you would be the right person to advise you on that. But these are some of the expectation or returns that you can expect from the various bonds that are available. This is just a sample. It's purely from education perspective. Please do not please do not take it that this is what is the return. It keeps on changing. It's market driven activity. If tomorrow interest rate cuts, you will get a lower return. Just like tomorrow, yesterday, some days back, SBI would decide that they would give a lower return on the FD, or they will increase the FD rate. The same way, depending on the market scenario, the returns also changes. There is capital gain also as an option. There is capital loss also as an option. So you need to understand what you want to invest. If you hold to maturity, whatever return coupon or the yield at which you have invested, at a definite period, you will get your principal back. So your return is fixed. In case if tomorrow the yield changes, you are allowed to even sell this in the market because there is no lock-in for listed bonds unless until you bought a specific bond with that nature, right? Kapilji, anything that you would like to add?
Yes, so the some of the questions I can see related to the yield and the basically the returns are there. Okay, so when we say about the yield part basically or the coupon, when we say the whenever the bond is issued, certain coupon rate will be there. So the coupon rate can be fixed, but yield varies. That yield will be totally depending upon the three basic parameters. Number one is the time duration till the maturity will be there. Number two is the price that you purchase and the price that you are selling into the market. So these three parameters will be there when the bond, when we calculate the yield. And yield is nothing but the internal rate of return or the required rate that is there into the market. The yield can vary from individual to individual. Let's take an example. If individual into the market, there are two different age class peoples are there. One is able to take a higher risk, so his yield will be somewhere higher as compared to the another person, and he will decide that if my yield rate is, let's say, 11%, so I should go with the A rated bond, because if I'll go with the GSEC will never give you the yield of 11% to you. Okay, because when you invest into the market, there are the yield curves available on the platforms like the Bloomberg or other platforms. If you can check it, the yield curves are there. So that yield curves will give an idea to you what will be the futuristic yield of the investment that you are making into the market. So 10-year GSEC will be there. So yields can be easily measured. So yield is nothing but the internal rate of return or the required rate that you are making into the market. And when you invest into the market, basically you have to correlate with the your expected returns, that is the yield, with the risk profiling of yours. So that should be very,
Perfect. That
and
really helps.
that will be helps to you.
Correct, correct. Uh, Before we move on to the next slide, Dr. Shimalji, I think we should launch the next
Business.
question just to poll. Guys, I request all of y'all. The last poll had 93% participation. I request we would prefer that if you guys can participate, all of you, 100% of your. So I'll read out the question. Which type of bonds are you are most interested in learning, right? Whether it is government securities, whether it is municipal bonds, whether there are corporate bonds or high yielding bonds. So just to understand more perspective, what is the return that you guys can expect? Whether what is the return that is coming out of this? So there are state guaranteed bonds as well. There are high yielding bonds. There are corporate bonds, which are a little high rated but low returns, which is like the REC, NABARD, LICs of the world. The government security is 6.8 to 7%. So just to give you some perspective, we have almost 85% participation. I request some of you have not participated. I would highly request you to please do participate to make this more interactive. We will be taking up your Q&A. We have a lot of queries that has come up in the Q&A section. We're almost towards the end of the presentation. There is a next slide will be explained by Dr. Shimal, which will tell you the risks attached while investing in a bond. What are different types? So just hold on and we'll definitely answer your queries in the Q&A section also. Uh, right. So we'll wait for another 10 seconds. I request anybody who has not participated in the poll, please do participate. What type of bonds are you most interested in learning about? Whether it's government bonds, municipal bonds, corporate bonds, high yielding bonds, what are the different categories, right? We'll end the poll. Thank you so much. We have almost 85% plus participation in this poll. We'll move on to the next slide, Dr. Shrimal sir.
So thank you.
Over to you.
Yes, so if I can see the poll, most of the people are there, those who want to invest into the corporate bond where they can expecting the return up to 11%, I think, if I'm not wrong on the poll part. Okay. But yes, if you'll say about the risk when you that are involved into the investing into these fixed income securities or the bonds, so like equity, whatever the instruments are there, all the instruments when you are investing into the market, that is subject to market risk. That is the most important part when you have to understand. Because when I interact with some of the people, I generally found that bonds are not risky. That's why I'm investing into the bond, or bonds are doesn't carry any other risk. But there are the examples in India and abroad also where the risk is associated. The first risk that I want to discuss, that is the liquidity risk into the market. Definitely, when you invest into the bond for a longer time period, let's take an example. If I purchase a bond of XYZ company today, and I hold till bond till maturity. So I don't have to bother about the liquidity risk into the secondary market. But if I want to sell that bond into the secondary market, there can be the risk, which is a liquidity risk, because it might be possible the bond is low rated, can be there. Or another example, let's take an example, some municipal bond is there of the small town which is not rated good, or the balance sheet of the municipal bond is not good. It will be difficult to liquidate into the market, because when we want to liquidate into the market, definitely we will see whether the buyers and sellers are available of that particular bond is there into the market or not. And bond market is very huge. The retail investor participate is less. So if I am having a bond which value 1 lakh rupees to me, and I want to sell that 1 lakh rupees bond into the secondary market, it might be difficult to liquid. But yes, it will be liquid with the help of your primary dealers or the bond brokers. They will help you to liquid. But yes, the liquidity risk is one of the example of the bond will be there. Immediately liquidity cannot be happen into the bond part. Number two risk can be the fraud risk is there. So fraud risk, we can take an example of, let's take an example, some company become done some fraud into the part, or that bond is not regulated by the SEBI, or under not come under the purview of RBI or any other regulatory body, and you purchase a bond. That if that bond doesn't have any underlying asset as a part of the security or the guarantee, or no regulation part is there, then the fraud will be there into the market. And this fraud, you can see there are in the history also, in Indian market also, there are certain companies, or in the foreign market also some companies are there which come under these fraud parts are there. So when you are investing into the market, you have to see whether that bond is regulated or not. If that bond doesn't regulate it, there can be a chance of having the fraudness into the market. That is one of the part of the fraud is there. Then next is the credit risk is another example for you. When we'll say about when we invest into the market, there can be the credit risk will be there. Okay, and there are the examples. Suddenly, let's take an example. The triple A rated bond is listed into the market, and the rating agencies or the regulation has taken certain action on that particular company, and suddenly the rating fell down. So there are the examples of DHFL is there, one of the example. ILFS is one of the example where the rating has gone down due to the credit worthiness of a company. The balance sheet are not performing, the financial performance is not good of a company. There can be certain management issues, and due to this, the credit rating has went down. If the credit rating went down, suddenly the bond can be convertible into the credit risk, and the liquidity will be not there into the market. And there are the examples also we have seen. So as we told, the AAA rated can come into the triple B minus or lower category bond based on the due diligence done by the rating agencies. But when you are investing into the market, you yourself has to do the due diligence also, because whatever the rating agency has done, that is done based on the best of their knowledge. But when you're investing into the market, you have to do your own research also before doing this. So credit risk can be there. Due to the credit risk, the rating of the bond can go down, and the examples that we discuss into the market also there. Now, some of the market risk is there. So when we say about the market risk, there can be the interest rate risk. Another best example of the interest rate risk we can see in since last 1.5 years or so, the Fed has reduced their interest rate, so increase the interest rate like anything. And due to this, some of the banks like Silicon Valley banks collapse due to the change into the interest rate of the Fed, because the interest rate or the yield and the price is inverted correlated and inversely correlated. If the yield goes up of a bond, the price will go down of a bond. So interest rate risk is one of the most important market risks is there when you are investing into the market. Some other type of risk in the market is there can be the inflation risk, there can be the reinvestment risk is there. So the best example is that, for example, when you purchase a bond 10 or 20 years before, and you are receiving a coupon of that bond every year, and the coupon that you received at the time of COVID-19 period in India, where the interest rate went down, so you are reinvesting that coupon at a lower rate of the market. So interest rate, or that is the reinvestment risk of the principal amount, or the reinvestment risk of the coupon that you are earning from the market. So that risk can be there. There is one more market risk is there, the call risk is there. So when the bond that we can say bond is issued for, let's take an example, for 10 years, but before maturity, if company calls the bond to redeem from the market before the maturity, after 5 years, company feels, why should I give more coupon to the investors or to the lenders if I'm getting the same money at a lower rate from the market? Okay, so what the company will do? Company will call the higher coupon bond from the market and issue the new coupon, or take a money from another source like the bank loan at a lower rate. So the company will call a bond. So callable risk can be there. There can be the country risk also. Okay, at the market is there can be country risk also, where the country become defaulter. And let's take an example. The Argentina is one of the example where the government has declared their souvenir gold bond as a default. They don't want to liquidate that particular bond. So that this is due to the economical instability and the political risk was there into the country. So these are the examples where you can see where the market risk is associated. So when you're investing into the market, you have to understand, or when you're investing into bond, you have to understand that my bond is associated with XYZ ABC, certain risk will be there. And if I invest into the bond, into the lesser graded bond. Already the bond is the B or triple B minus rated bond is there, so that already carries the higher risk, and suddenly that company become defaulter, so it can create the liquidity risk for you, it can create the credit risk for you, it can create the market risk for you, or it can create the event risk also. The bigger event, like let's take an example of the COVID-19 is one of the examples, subprime crisis is one of the example. There can be the n number of risk is associated, and when this risk is there into the market, you have to understand that this will affect the returns, this will affect the liquidity, this will affect the maturity value of your bond. And you can see the n number of examples in the Indian market. There are the examples of the ILNFS that I told you, DHFL is there, Sahara is one of the example. These are the examples are there into the market where the liquidity is an issue and challenges for the maturity. At the time of maturity, the money should come back to the investors. And when you are investing into the fixed income security, our perception is that it should not have certain risk, but yes, bond is also having a risk, and this risk are major risk. And if you see any of the global financial crisis, if you go to the Japan bond crisis, US bond crisis, European bond crisis, subprime crisis, souvenir gold bond crisis, these all crises are there which are linked with the fixed income securities of the country, because fixed income security size is much more bigger in the European and American market as compared to the Indian market. And the best example is Silicon Valley banks. That's a recent example. Suddenly Fed has increased the rates, Silicon Valley bank collapsed due to the lesser value of the bond they have invested into the market. So you have to understand the risk which is associated in the fixed income security. And if you understand the risk, if you want to invest into the market of the fixed income security, to understand the nature of a bond, you understand the risk of the bond. Again, the expectation, because as per the poll that we conducted, your expectation is to earn the 11% or 11.5%. If the bond is going to, again, suddenly the government is saying that the bank rate is near about 6 to 7% and expecting 11% return from the bond, so risk is associated. You have to understand the nature of risk into the market. Okay, so this is from my side, Saniji, on the risk part. If you want to contribute anything from at your end, you're welcome on this part.
Absolutely not, Dr. Shimalji. I think you've covered with the right example, and it really helps our audiences also understand. A few people have also commented that this gives a very good perspective. We will soon take up the set of queries also from the next slide. Just one last poll we will quickly release for the audiences to participate. Which asset class currently dominates your investment portfolio? Whether it is fixed deposit, whether it is direct investment, or real estate or mutual funds. So example, if you have 100 rupee, out of 100 rupee, which is the maximum investment asset class that you currently invest in? Uh, I think I should have added, instead of fixed deposit, I should have added bonds also. Uh, I think I missed out on that. At least some, but I'm sure if bonds were dominating, we would not be taking this investor education initiative,
Yes,
right?
yes.
So, which asset class dominates your investment portfolio? 70%, of the people have already participated. I request everybody else also to do participate. 75, 76%. Come on, guys. आई एम रियली लुकिंग फॉरवर्ड टू यू गाइस टू पार्टिसिपेट. सिंपल है, फिक्स्ड डिपॉजिट में आपका सबसे ज्यादा पैसा पड़ा है, डायरेक्ट इक्विटीज में आप एक्सपोजर लेते हैं, रियल एस्टेट में लेते हैं, म्यूचुअल फंड. वैसे तो रियल एस्टेट सबसे ज्यादा नॉर्मली पैसा इन्वेस्ट करने के लिए लग जाता है, बिकॉज बड़ा एसेट है, एसेट क्लास है. Obviously, SEBI has taken some initiatives for fractional ownerships also through SME REITs as well and REITs as well. But I'm sure a lot of you guys are investing in direct real estate. Okay, we have like 89% people participated. Request others also to please participate. Uh, we'll just run this. We are almost towards the end now. We'll be taking up the Q&A section as well. So just to give you guys some perspective, 36%, 35% of the people are in mutual fund, 10% approximately in real estate. Direct equity is 35% and fixed deposit is still 21%. I'm really sure that after this, probably this investor education initiative, we will be seeing more of you guys to also evaluate bonds as an education, not from an investment, but at least be educated Don't make any investments if you're not comfortable, but do ensure that you know about this asset class. SEBI has taken a lot of initiatives to ensure that it reaches out to retail audiences also. Minimum investment was as high as 10 lakh rupees, which is now got down by SEBI to as low as 10,000 rupees. We'll end the poll now. We'll move on to the next slide. In this webinar series that we're doing today, we will be covering 6 webinars at least. Every month we'll come up with one webinar. The next webinar that we intend to come up with is bonds versus other asset classes. So the reason why I asked that question is because a lot of you guys have invested in multiple asset classes. It's not whether one asset class is correct or one asset class is right and the other is wrong. No, you have to diversify. You have to see what is your risk reward ratio. What are the pros and cons of every asset class? Is any asset class perfect? Answer is no. Is any asset class bad? Answer is no. It really depends on how informed decision you as an investor you take and you make the decision on which asset class. So the next webinar is just from information perspective and education. Not, we are never going to say that any asset class like bond is good or equity is good or FD is good. All asset classes are good depending on a risk reward ratio that you can decide, but make sure that whenever you make an investment, don't go by herd mentality. SEBI also keeps on saying that, NISM says that, Dr. Shrimal ji also educates that just because कोई friend ने बोला तो invest मत करो, educate हो and फिर invest करो. And I'm sure you guys know all the initiatives that NISM is also taking, and that is the reason why they've invited us also as India Bonds, as a SEBI registered OBBP, to ensure that whatever decision is made, it is made on the basis of correct information available. Accessibility is the biggest problem that as an OBBP we are trying to solve. Dr. Shrimalji, we'll move on to the Q&A section.
Yes, please.
Okay. So the next webinar also we'll definitely announce soon. But we'll first read out the questions. Shrimalji, should I read out? Is that okay?
Yes, please, sir. You can.
Okay. So the next question is, what is the difference? This is by Dheeraj GG. What is the difference between secured and senior secured bonds? So, Dr. Shrimalji, would you like to take it? Should I take it?
Yeah, you can take it, then I'll cover.
Okay, I'll take this. So धीरज जी, secured bonds. So जैसे डॉक्टर शिमल जी ने एक्सप्लेन किया था, whenever you invest in a bond or whenever you invest in any asset class, hierarchy wise in terms of priority, let's assume that you invested in an ABC bond of a company ABC, you have invested in a bond. In terms of security, whether it's a secured bond or an unsecured bond, basically, most of the secured bonds are treated as senior secured bonds unless until explicitly specified. Any bond that you invest in terms of priority, a secured bond will be paid out first. Unsecured bond will be paid out next in case of liquidation of the asset. Example, a company has raised 100 rupees, has assets worth 70 rupees. Whenever those assets are liquidated, in case if the company goes bust, out of that 70 rupees, a senior secured lender or a secured lender will be paid first. An unsecured lender will be paid next. Like fixed deposits are unsecured. So on priority, it will be paid next. Senior secured lenders will be paid first. Equity is the last priority in terms of security. So that's what is the basic difference between the two. Dr. Shimalji, would you like to add something or that's
No,
fine?
that is perfect.
Okay, we'll move on to the next question. Okay, I think one more question is for the same. What is senior secured bond? Next question is, what is the minimum credit rating that one should consider for investing in the bonds of safety, for safety, by Mr. Samir Nayak?
So safety, I think it should be always considered as a triple A rated bond. It should be the minimum you should go, or the GSEC should be there, because there can be the minimum part. Yes, but that depend upon person to person. If the person wants to take a risk, so even we have seen in the Indian market or the global market where triple A rated also become the triple B minus bonds are there. But yes,
Absolutely.
it should be triple A, should be the minimum secured. You just have to diversify your portfolio by getting the minimum return with the security should be considered as per my purview. Sunny ji, if you have any opinion.
Absolutely, absolutely. If you have a low risk appetite, you want a high, you're okay with a lower return, invest in a government security, a GSEC, which is risk-free return, and which is considered as risk-free return because that's the lowest risk. Next is a AAA. Depending on your risk-reward ratio, then you could look at investing in that. I hope that answers the question. Next question is by Mr. Pawan Bhatt, which says, can HUF invest in bonds? What are the taxation liabilities attached to a bond? Should I
So
take it up?
yes, you plus.
Okay. So, Pawanji, yes, as an HUF, you can make an investment in bonds. You should advise your chartered account, take advice from a chartered accountant. Is it possible? Answer is yes, you can invest in bonds by HUF. I personally make investments through that because of taxation planning. But taxation is the same as tax slabs, depending on whichever tax slab you fall in. According to that, again, I'm not a tax expert. I would advise for any taxation related queries, request you all to please speak to any tax expert or a chartered accountant. But yes, to the best of my knowledge, it is as per your tax slab. Okay.
So again, it will be considered as a long-term or short-term capital gain will be there if the bonds are listed into the market. So more than one holding is considered as a long-term capital gain, and less than 1 year will be the considered as a short-term capital gain will be there into the market. And whatever coupon you are getting, that coupon will be considered as a part of the income to you. It will come as a tax slab to you. And for the long-term and short-term capital gain, as per the finance bill, there are certain rates are there. Approximately, I think 10% and 20%, 10 or 20% is there, which will be the taxation part you have to implement on this.
Absolutely. Perfect. Perfect. Next question is by Mr. Mohit Dingwani. How these credit rating agencies decide the credibility of the bond issuer? So Moji, credit rating agency is a SEBI registered and a SEBI regulated agency. They go through the financials, they do the analysis, they review the financials on quarterly and half yearly basis as well of companies. Depending on various aspects that they go through, they have their internal analysts, they have their internal rules, they have their internal processes, and it goes through a proper committee. And on the basis of that, the rating agency assigns a credit rating. It's an opinion. It's not a guarantee. It's a third party neutral opinion, wherein it's more for guidance for any investors. Okay. Next question is by Komal, what is private placement of bond? Okay. So, the bond market segment is bifurcated in two segments, capital market segment and wholesale debt market segment. Both these bonds, whenever you buy through at least an online bond platform or through an exchange, these are basically listed bonds. Whenever a bond has limited number of investors, which is a maximum in the primary issue, like an equity IPO aata hai, the same way whenever debt or issue is opened or a bond or an NCD issue is opened, they have an option to go through the private placement, wherein maximum 200 investors can participate in a bond issuance. In case if it's not a private placement, then it is called a public issue, wherein it is open for retail as a whole. That is called capital market segment issue. So if you are buying a bond which is in the private placement segment, the face value currently has been up to 1 lakh, which now SEBI with certain rules and conditions can go down to as low as 10,000 rupees. And in the capital market segment, the issuance is as small as or the minimum investment is as small as 10,000 rupees. Like tomorrow, a public issue is opening up of Muthoot, in which investors like you can invest as low as 10,000 rupees from any platform through a broker or anybody. That is the difference between the two, right? Okay. Next question is okay, sir. Is it okay? Next question is Anshu Alumalai. Sir, is it possible a student can invest in bond? Can you tell
Yes,
me some
yes.
basic process about the same?
So anyone can invest into the bond. The thing is that you must have your proper KYC should be done. That is one of the part. You must have your Demat account or with the help of your broker also, primary dealer also, you can invest into the bond. So your KYC document should be there. When we'll say about the KYC, the Aadhaar card, PAN card, bank account details must be there. Anything else you want, Sunny ji, a part of the KYC?
I agree. You have to invest in a bond through any SEBI regulated entity. and they will be doing your KYC. It is compulsory for them to do that. As long as you would like to invest, you can go ahead. There are some rules and conditions around minors. So that probably depending on your broker, you can speak to them and they will guide you on the same, right? Depending on whichever platform that you like to invest. But as long as you are a senior, you are a major, which is above 18 years, I don't see there is any restrictions from that perspective, right? Uh, Next question is Nikhil. Nikhil ji is asking which rating agency is more reliable out of these five. Uh, Unfortunately, all rating agencies are semi-regulated. They are third-party rating agency opinions. There is no specific choice that probably we'll be able to like tell you. But I can. Some people have asked a question also. If there are two rating agencies rating a bond, and if one is given a double A rating and the other is given a double A plus, I can definitely suggest to you that please consider lower of the two. Do not consider higher of the two. Always be safe. That will be a better approach. Dr. Shimal ji,
Yes, that true. Lower of the two must be the best.
always consider lower of the two. Risk reward ratio also should be. I think that question Mr. Rajiv Bantwal ji has raised that question. I hope that answers your question as well. Palak Sajdev ji has said which two documents to be checked for bonds. So two very basic documents. There are more, but one is the information memorandum or the disclosure document because that is the Bible. The second is the rating release or the rating rationale that you should read. Plus, you should go on exchanges and also go through the financials because these are listed bonds. It is compulsory for all issuers to publish their financials. Please do go through them also. Do your basic thorough due diligence before making any investments. Okay. Next question is Vino Mukandanji. How very often GSEC have a yield less than fixed deposit? Is there any advance of GSEC over fixed bank fixed deposit? Dr. Shimalji, would you like to take that?
Advance means if it is
I'm assuming, is there any upside in investing in a GSEC versus a bank FD?
so
That
bank
is
FD, yes, there is one part is there. The bank FD having if we consider in bank is a liquidity risk of a bank FD. So limit is maximum cap given by the RBI is 5 lakh rupees. That is the one part is there. Whatever the liquidity risk will be there. But in the GSEC, there is no maximum cap is there. Number one part. And there are certain GSECs of the state GSECs will be there. They can offer higher yields compared to the bank FD at some point of time. Because currently bank FD, if I'm not wrong, bank FD is currently giving near about 7% interest to you. Okay. But at the same point of time, the GSECs are there available into the market where 7.5 or 8% yield is also there will be to you. So this is one of the part of this, Sunny ji, if you want to add on this part.
no, I agree. You can expect a 7% plus return in GSEC as well, depending on the tenure and higher liquidity because it's easily you can liquidate the same. Any broker or anybody can help you execute the same. Next question is quite similar to that, but we'll take that up. Ankur Desai ji, ESAF Small Finance Bank. It's a small finance bank which has raised bonds. Can banks other than small finance bank also issue bonds?
Yes, the
Um,
answer is yes. All
Correct. Absolutely.
answer is yes. So any bank or any institution or any corporate can raise a bond with the
Correct.
permission of the SEBI, basically.
Correct. So all banks are allowed to issue bonds. There are different types of bonds. There are subordinate bonds. There are perpetual bonds. There are tier 2 bonds. There are various types of bonds issued by banks. Currently, like if you look at ESAF, it is available at a 11.3% kind of a return on any platforms that you look at buying. The same way, other banks have also issued bonds, which are including the likes of PSUs like SBI, Bank of Baroda. These are also available. However, please remember perpetual bonds are a little riskier bonds. They are just in risk reward ratio. They are unsecured in nature. So ensure whenever you're making these investments, you're aware about this and taking more informed call. Please do talk to your advisor and your financial guidance, whoever is guiding you, and somebody who is licensed to advise you on the same. Right. Next question is, sir, if you could explain, Anuj Setheji, what is the difference between YTM? Is the IRR based on yield to maturity?
Is the IRR?
IRR based on yield to maturity, YTM.
Yes, yes, IRR and YTM is same. So it is nothing but when I am, for example, I am making an investment of 1,000 rupees in any of the bond. For next 5 years, it will be keep invested, and that bond is going to give me the next 5 years certain coupon also to me. So that coupon is nothing but the interest I'm getting. Okay, and we know over the period of time the value of money is depreciating. Okay, so it will be discounting by a certain rate. Okay, and what whatever money at the end I am getting, including the coupon, whether it is higher than the current value or not that I invested. If it is higher, then that is the more good example for me. But minimum that return should be given to me, so that will be the yield. So whatever amount I invested over the period of time, maturity, so that is nothing but the IRR or the YTM is nothing but amount that you invested today. Over the period of time, you're getting that amount back with certain coupon. So the inflow and outflow should be at least equal. At that should be your IRR. So it might be possible that my yield can be the expected, it can be the 8%, and that bond is giving me 7.5% yield currently into the market that's showing 7.5%. So it can be decided that I should not invest into that bond because my expectation is 8%. So I will select the bond which can meet my expectation of 8%. So that is the yield concept will be there basically.
Perfect, perfect. Next question is by Mr. Sajil Seth. When will the new tax-free bonds IPO come up? I have not found since 2018. Uh, so unfortunately, Sajilji, I don't think so. Dr. Shrimalji would also know, or I would know. It is not publicly available. However, these bonds which were issued in 2018 or before than that, they are available on platforms as tax-free bonds. Returns are obviously different because that time somebody is invested versus today. But in the secondary bond market, you can definitely look at buying this. So I would urge do a little bit of research, speak to a few of your brokers, or look at platforms online, and maybe you will be able to find something. But right now, we don't have any public related information that these bonds are coming up, government is coming up or not, because we wouldn't know that. Only when publicly available, right? What is the tax implication of investing in a bond?
So
Mr.
that we
Mohammed
are
Wahid.
that we have discussed text part with that we have.
Correct. We have already answered this. Just to give a refresher, it's as per tax lab, TDS is deducted on unlisted bonds at 10%, and there is long-term and short-term capital gain tax that is available as per the requirement, right? Milind ji, आपका भी same query है. What is short-term and long-term? You have added to that. So long-term capital is in case capital gain is when you hold on to a bond and sell it in the secondary market after 1 year. If your holding period is more than 12 months, then you get long-term capital gain in case if you sold it at a higher price. एग्जाम्पल, आपने कुछ चीज 100 रुपए में लिया है, 110 रुपए में बेची है, बट वो 1 साल से ज्यादा आपने होल्ड किया है, तो लॉन्ग टर्म कैपिटल गेन लगेगा. अगर वो 1 साल से कम है, तो आपको शॉर्ट टर्म कैपिटल गेन लगेगा. And in mutual funds, the same thing for long term is 36 months, if I'm not wrong, Dr. Shrimalji, on the fixed
Yeah,
income.
no, fixed income. If the bond is not listed into the
Ah,
market, then 36 months is there.
that is correct. That is correct. For listed bonds, it's more than 12 months.
For listed month is more than 12 months.
Okay. Next question is by Mr. Naveen Kumar. Is SEBI having rights to eliminate or control non-regulated bonds in the market to safeguard investor capital? Uh, Naveen ji, yes, SEBI is there definitely to protect investors. They are trying their level best by having NISM as one of their institute to take these education initiatives. That's when they have invited us. We are trying our level best to educate and inform the audiences that look at regulated products. There is very limited that we can do. We cannot stop somebody from getting into any wrong advice or wrong instruments, but we request that please do invest if you want to make investments in any of the regulated products. Like it can be whether RBI or SEBI or anybody, but do look at investments only in regulated products, right? Mm, So one audience, Dr. Shimal sir has requested, can you explain credit risk a little bit once again?
Okay, so just giving again in depth some about the credit risk. Credit risk is nothing but when you invest in any of the bond, let's take an example. The bond is AAA rated currently today into the market. Bond is AAA rated, and based on that AAA rated, you are invested into the bond for a longer time period. Okay, and over the period of time, we can see the economical condition is changing, the political risk is also there, the global risk is also there, the company risk is also there into the market. And after a certain time period, again, the evaluation is done by the credit rating agency, whether whatever the evaluation that we have done for that particular bond, whether it is or the company that is particularly right or wrong. Okay, and suddenly the company will found that since last 5 years or 3 years, the balance sheet is not good of a company. There is a loss into the company's part, most of the cases. So the company, the credit rating agency will feel at the time of maturity, if the company doesn't have the sufficient fund to give the coupon to the investors or doesn't have the sufficient reserves to give money back. So what the credit agency will do, it will degrade the rating of the company from AAA to let's say double B or triple B minus, something like can be there. So this is an example that we discussed. Even ILNFS is one of the best example. DHFL is one of the best example is there. Okay. And suddenly the rating went down. If the rating went down, it means that is a credit risk is there. So it says that the rating agency is saying that company currently doesn't have sufficient fund. So risk is associated when the maturity will be there. And if you hold this type of bond will be there for the over the period of time, that if the company become defaulter, there will be the risk. So these are certain examples that we can say of the credit risk into the market. Okay. And there can be the credit risk of different, even government also of certain countries also can bear a credit risk. But yes, it is nothing but the credit spread over there over the period of time. So that is from my side. Sunny ji, if you want to add something on this part.
No, absolutely, Dr. Srimalji. I think you're covering it perfectly. Just one question that two, three people have asked again. If you could explain the difference between a coupon and a yield, sir.
So coupon and a yield, coupon is nothing less than example, very simple example I'm taking. If the bond is issued into the market at 10% coupon rate. Okay, 10% coupon rate. So 10% interest rate that we are in general terminology, we are saying that interest. So interest is known as a coupon. That 10% you are getting fixed on a face value or the period of time of a holding. But yield can be higher than 10%. Yield can be lower than 10%. That you have to understand. Because that bond is traded into the secondary market. So when you purchase a bond at a face value of 1,000 rupees, that bond is available now in the market. Let's take an example at 9,800 1,000 to 9,980 rupees. It is currently sellable into the market at 980 rupees. So in the secondary market, you're purchasing that bond at 980. And again, you'll hold that bond till maturity. At the maturity, you are going to receive 1,000 rupees. So that yield will be there. So yield and price is inversely correlated. It means if the yield of a bond is high, the price will be lesser. It means that if the bond is traded at 980 rupees, so that bond will give higher yield than the coupon. And if the bond is traded at 1,010 rupees, so that bond yield will be lower than the coupon. That you have to understand. The yield can vary from coupon. And if the yield and coupon will be same, then the market price of the bond and the face value will be same. Understood? So yield can vary. So yield can vary, that depend upon the market demand and supply. Yield can vary depending the time to maturity. Yield can vary depending to the current market price. So yield can have the various permutation combination. Even yield can vary due to the interest rate also. That is a long-term G6 or the Fed rates or the RBI rates, yield can vary. So this will be varied. But yes, coupon will remain fixed till the maturity. Yield will not remain fixed.
Sir, can you also add how interest rate affects bond prices? Because a lot of people, three, four people have asked. So,
Yes. So how interest rate affects the bond prices? Interest rate simply affect the bond prices because if that bond is, I'm just giving this another simple example to you. If that bond is when it's issued, let's say 5 years before. when the interest rate was near about, I think, uh, uh, 5 years before, I think near about 7% or less than 7% was there. Okay. And suddenly, or another example, if you go to the US market where the interest rate was almost less than 1% was there. Okay, that time the bond prices was high. And Fed has increased the interest rate. If the interest rate is increased, it means another opportunity is there into the market. The liquidity of the bonds will be there. So there is a interest rate affect the market. Long term yield will be higher. So another example, if I'll say, let's take an example. Currently, the interest rate or the yield rate is 7.5%. In future, the yield rate is showing that the 8%. It means the long-term prospect is higher for the holding of a bond. So yes, interest rate affects the bond price, because when the interest rate change, as an investor or as a trader, what I will understand that over the period of time, if interest rate will go up, the bond price will go down, because that is an inverse relation as a part of the calculation that we have to understand. Because till the maturity, if the interest rate will high, the prices will go down of a bond, because that affect the interest rate, affect the that considers a discounting rate of your bond. That considers a discounting part. So when you do the calculation of a bond, yes, it will reduce the price of a bond. So if interest rate high, then it will higher discounting. So that is considered as a discounting part.
Agreed. Sir, a lot of people are asking the difference between a debenture and a bond.
So, in a single terminology, if I'll say, the bonds are generally issued by the government institutes, or we can say the PSUs, and debentures can any corporate, even corporates can also issue the bonds. But yes, debentures are mostly issued by the corporate. Number one part is there. Bonds are more secured, debentures are lesser secured, that we can say. And the debentures can have the liquidity position when the company become default. For example, the repayment will be given to the first priority, will given to the bond holder, then the debenture holder will be there. And usually bonds are non-convertible, whereas the debentures can be convertible also. These are some of the difference. Otherwise, all the corporates or the companies, they can say it can be the debentures, and the PSU or the government or the municipals, they are saying the bonds. That is the major difference between the bonds and debentures. Saniji, if you want to add something on this part.
Absolutely. Private sector corporate issues a debenture, a
Debenture.
public sector issues a bond. That's the basic difference. The both of them are very similar, identical instruments, just two different names. Then depending on the type of bond, whether it's secured, unsecured, or a debenture which is secured, unsecured, have a look at it, go through the information memorandum, right? Some people are asking the difference between an FD and a bond. I would request please attend our next webinar. We will definitely covering the doing a proper apple to apple comparison, and we will be covering the same. Next question is, what is the time till which we can, Samay Patel, till which we can hold bonds in our portfolio?
So time, that depends upon individual to individual.
Correct. So it is your choice. There is no restriction in terms of how long you want to hold. If it's a 5-year bond, you can sell in 2 days also, or 1 year also, depending on the liquidity of the bond. And also you can hold it till maturity, and on the maturity rate, you will get your principal back, Samaji. Right? Next question is Karpaka Rajan ji saying, even investors in Yes Bank subordinate bonds have lost. So let me add to this first, Karpagaji, that Yes Bank bonds which were invested were not subordinated debentures. They were perpetual bonds, which is higher risk compared to a subordinated bond. These are called Tier 1 capital bonds. Right now, whatever bonds that are available of Yes Bank in the market are either infrastructure or a subordinated bond. It is not a perpetual bond. So between the two, what a government has taken some actions is on perpetual bonds and not on subordinated debentures. Dr. Shimalji, would you like to add something to that? Okay. Next question is, why fixed deposit is unsecured? Why would probably we wouldn't know, but as of now, majority of the fixed deposit that are issued are unsecured. Maybe Dr. Shimalji, if you have any
So
points to
fixed deposit is that told earlier also it is a cap of 5 lakh rupees. So if I'm having the deposit of all the bank account with let's say 50 lakh rupees of fixed deposit I'm having, and suddenly my bank become defaulter. So RBI is liable to pay me the 5 lakh rupees. That's why it is a unsecured that I can say. There is no upper limit beyond 5 lakh. And that was revised I think 2 years before only. Earlier it was 2 lakh rupees only.
correct, correct. So we are actually over short of time. We have a lot of questions.
Yes.
Ishwaranji is asked, there is no risk in investing in bonds by government of India. Answer is it's the lowest risk. Government
Currently,
of
it is
India.
the lowest risk that we can say. But yes, there are the countries over the globe where the country become defaulter. So Argentina is one of the example, or the I think Iceland at the time of subprime crisis is one of the example where
Correct.
country become defaulter. So currently in India, yes, it is a risk free. Where the
Correct.
zero risk you can say.
Correct. Absolutely. I think we've overshot time, sir. We've answered over 70, 67, 8, 70 queries. We've tried to cover as much as possible. In case if there are any queries, please reach out to NISM or India Bonds and we'll be more than happy. I think we've overshot by 15 minutes. The next webinar we'll be hosting very soon with NISM, which is on bonds versus other asset classes, wherein we'll have a basic understanding of bonds versus FD, equity, mutual funds. So we'll try request all of you all to do participate in that as well. Unfortunately, due to time paucity, Sripalji, would you want to take one, two more queries?
Not an issue for me if you are open. So
Yeah, I'm absolutely okay. We'll take another five queries at least. I think we've already answered what is the difference between bonds and debentures, so I'm not taking that question up. Uh, Next is Janvi Sudaramanji. Investments of bond can be made through Demat account.
yes, it can be made.
Correct. So, Janviji, majority of the bonds that are issued currently are in Demat form. You can use your existing Demat account and make investments. You don't have to open a separate Demat account for bonds, at least which are listed on the NSE and BSE exchanges. You can buy through any SEBI registered OBPP, and you can use your existing Demat accounts also, unless until they say that they want a separate Demat account. But majority of the people allow you to make investments using your existing Demat account. So you have only one Demat account where all the pool of assets are there. So, to answer to your question, next
One question I
question
can
is,
see, what is the 54 EC bond? I think 2 to 3 times.
sir, please do take it up.
So the 54 EC bond is nothing but it is the bond, special type of bond which are issued by the in India, especially it is issued for the offer of the exemption of the tax on the long-term capital gain that we can say, and it is backed by the government. So the institute like the National Housing Highway Authority of India or Rural Electrification Company, so any backed by government can issue this particular bond. But generally, the lock-in period is the 5 year of this particular bond is 5 years will be there. Okay. And the maximum limit that one can invest in one financial year is the 50 lakh rupees will be the part. Otherwise, these bonds are on the particular part of the tax. So there is no TDS on this particular bond is there into the market. So maximum cap is 50 lakh rupees, and these are the government of India backed institutions or the corporations issued this particular bond. So like the Power Finance Corporations or IRFC, they issued this type of bonds into the market.
Correct, correct. Next question is Tyrese Almeida ji. They are asking, is primary market accessible to retail public?
Yes, the answer is yes for the GSEC also and for the corporate bonds also. Both the markets are accessible to the publics.
Absolutely. Even tomorrow, Muthoot's public issue is also opening up. So you
Yes.
can also look at investing in the primary market. It's on first come, first serve basis. What is meant by PSU? Prajaktaji, public sector undertaking is what we were referring to. Apologies if I've used the terminology. Public sector undertaking means public sector companies. Question is bond and debenture. If company defaults, are we getting our investment back? Yogeshwarji. If company defaults, are we getting our investment back?
So, if company defaults at the time of liquidity, if the funds available with the company, yes, definitely you will receive your investment back. But
Absolutely.
it's subject to total liquidity position of a company.
Correct.
Valuation will be done at the time of liquidation, then only it will be the possibility.
Right. Arnav Tiwari ji is asking, good evening, sir. Other than SGBs, what are the other types of bonds a beginner investor can choose to invest? Arnav ji, the most safest or the least risky, I would say, is government securities or SDLs, which are state development loans, which you could look at investing, or a AAA rated bonds that you could look at investing as a beginner. Next question is how to differentiate between a listed and a non-listed bond.
So if listed bond is there, it will be available on the platform like NSE, BSC or other website, but non-listed bond details will be not available on the exchanges.
Correct, correct. And if you are operating or working through a SEBI registered broker or a SEBI registered online bond platform, OBPs are only allowed to advise or not advise, but available on their platform if those are listed bonds. So it is compulsory for all OBPPs in their website whenever you go into the bond detail page, whether this bond is secure, is listed, unlisted, secured, unsecured, everything. Everything is already there and it is compulsory for all OBPs, as it's a mandate from SEBI that they have to show that whether it is listed or unlisted. First thing, as an OBPP, you are not allowed to show unlisted bonds because it's not regulated by SEBI, right? Next question is, what is meant by bullet redemption and what is a callable bond or a puttable bond? What is a call or a put option?
So the bond is having the options like there are two types of bond we can say. One is the option amended bond. Number two is the plain vanilla bond. So generally the bonds which are issued into the market, they are the plain vanilla bond. But yes, if bond is having the option amended bond, so before maturity, the company is having a right to call. Company is having a right to call, that is right to redeem, call back the bonds before the maturity, and the puttable bonds are there. The investor is having a right to put to the company before the maturity. That depending upon the position. Let's take an example. If I'm an investor, I purchased the bond, which that bond is giving me the coupon of 6.5% into the market, and the yield is 6.8%. Let's take an example, simple example. But as an investor, I can see if bond is not available for trading to the secondary market, if I can see if the bond is puttable bond or the option embedded bond, and if I can see into the market, another instrument like the fixed deposit is giving me the 8.5% return. Okay, so what I can do, so I will invest into the 8.5% rather to invest into the 6.5% coupon. So what I will do, I will just put this bond to the company back and invest the money into the fixed deposit. So when the alternative options are there with the from the company perspective, if they can borrow the fund at a lower rate, then they can call. And from the investor perspective, we can invest the same fixed income security or the same rated bond with a higher yield, we can invest into the other bond. So this is an example of the callable and puttable bond is there. Sanjay, you want to add something on this part?
No,
Or?
sir, I think I agree with what you said. Avinash ji, 54 EC, we've already answered. Next question is, are bonds stored in demat account? Answer is absolutely yes. There may be a dematerialized also, but majority of the bonds today issued are in demat form itself. We'll take one last
Last
question.
question, yes, we can take.
Yes, yes. Where to invest in bonds? Online brokers like Grow, Zerodha, are they safe, or direct through RBI retail app, or through Bhavya Agarwal has asked this question, or through any online bond platform? Yes, Bhavya ji, you can make an investment through any of the platforms depending on the availability. Do check multiple platforms. एक बार check कीजिए जहाँ पे जो available है. RBI Retail Direct के through also you could look at buying any government securities, or you can buy through Zerodha's or the Grows of the world, or through an online platform, or any through online bond platforms. That
So
is
main thing is the liquidity must be there wherever you're selecting a platform. That platform must have the liquidity to you.
absolutely correct. Avinash ji, we've answered your 54 EC. Multiple times we've got that question. Sorry, Babaji, we've already taken up your question, so we'll not be able to take that up again. Uh, okay. I think Kapilji, we've taken up a lot of questions.
Yes, lot of questions.
Yes. I'm really sorry for missing out on any of the questions that we would have missed out. We've answered 89 questions to be precise. Uh, so due to limitation and paucity, we've overshot the time already. But however, we'll definitely look forward in case of any queries, please feel free to write to NISM or to us. In case if there is any help that we could be of, we'll be more than happy to assist or answer your queries. And do have a look at our next webinar coming up soon, and we'll try to address as many queries as possible. Right. Thank you so much, NISM team, for inviting us for this, and Dr. Srimalji also for helping me with this session.
Thank you, Saniji, for giving your time because as a corporate, it's a working day for you, and I can understand market
It's our
timing.
privilege, sir. Till the time we don't educate, we will not see this bond market grow the same way how we've seen equity market.
Yes.
Equity is a very big example. Today, everybody understands the same thing. We are doing accessibility reach for our investor audience, and more importantly, informed investment decision making.
So, Pragya ji, over to you.
Good evening, everyone. I am Pragya from NISM. Before we wrap up today's session, I want to take a moment to express my heartfelt thanks to our incredible speakers, Dr. Kapil Shrimal and Sri Sunny Mirchandani. Your insights and expertise have truly made this session valuable. We appreciate the time and effort you have put into sharing your knowledge with us today. I would also like to extend my gratitude to all the participants. Thank you for taking the time to join us and for your active involvement throughout the session. We hope you found the webinar informative and inspiring, and we look forward to seeing you in our future events. Thank you once again. Have a great day ahead.